This podcast is brought to you by Curate Investments. Each of our funds is managed by different teams of highly skilled people we have handpicked to look after your money. That is the art of investing. For more information, visit us at curateinvestments.co.za. Curate Investments is an authorized FSP.
Welcome to another episode of Honest Money. We're joined today, as you can see on screen, not by Peter de Villiers, but by Ray Mhere. And Ray is the CEO of Curate Investments and a long-time supporter of the Honest Money podcast. So I'm very happy to have you back, Ray. Thanks so much for joining us.
Thanks, Warren. Yeah, it's been a couple of years, but I'm glad to be back. Thanks for the invite.
We have to keep you media fit, so I'm glad you're back. I think today's topic is very kind of relevant and pressing for investors around how to select a unit trust. And just very quickly, for most people will understand a unit trust, but just a little bit of background. So when we talk about a unit trust, it's something where you pool your money with other investors, and we would all together say we're going to buy, with our pool of money, we're going to buy a range of investments. And a range of investments in unit trusts is quite wide. It could be anything from a money market type investment where you're just trying to earn a rate of interest, right through to global shares, even specialist sectors of shares, for example, where you could buy financial services or mining houses, etc. So everything in between, with cash, bonds, property, and blended together in a range of different ways. So it is, in my view, one of the very best types of investments for private investors. And I would guess nowadays, I haven't actually got a statistic to back it up, but I think it's probably one of the most popular ways for investors to grow their money. The difficulty with unit trusts is there are now tens of, if not hundreds of thousands of them. So when we're sitting here and we want to, decide, like someone's listening to our show and they decide, okay, I'm going to go off and choose my unit trust. If it was a published list of funds with information, it would probably be many, many, many encyclopedias worth of information. So we've got to find a way to help people narrow down that selection of funds. And I almost think the way to do this is to say, if they're whatever they are, 150,000 unit trusts, you don't need to try and research every single one. What you need to do is find a way to cut out all the types of unit trusts that are not relevant to you for this purpose, for the purpose that you're investing your money. And so, Ray, I thought, I'm not putting words in your mouth, but for me, probably the most critical criteria when you're choosing to invest is, how long are you planning to invest this pool of money? So this is not about all of your money that you've got all around. This is saying, I've got my 10,000, 100,000, million, 10 million, whatever, and I'm choosing to invest this money for a particular period of time. So the jargon is the time horizon. And in my opinion, probably the key sort of defining criteria for what you should decide when you allocate money.
Yeah, no, 100%, Warren. And you're spot on about how many funds there are. It's actually, if you look at it, it's quite incredible. In South Africa, I think there's close to 2,000 unit trust funds for investors to select from. And then if you go globally and you start looking at diversifying and you want to invest outside of South Africa, there's close to 200,000 funds. So I don't know how the average investor is supposed to make those kind of decisions by themselves. But yeah, 100%. I think starting with what you mentioned is time horizon, and maybe even a step back, is what is the goal? What are you investing for? Because I think that'll give you the idea of what the time horizon is. Are you saving for retirement? Are you saving for your kids' education, which is varsity? Or is it money that you're just parking for a little bit? Those kind of decisions, figuring that out. And I suppose your investment goal or your investment objective will let you know what the time horizon is. And that is critical information that you need or require in order to get to a point where you can start sifting through the noise of this, this is what they call this paradox of choice of all these funds that are available. So start with what are your goals? What are you investing for? And that'll help you identify how long do you want to invest for.
Yeah, I think, and maybe just to stay on that for a little bit. So, very simply, as far as I'm concerned, and it's got to be simple so I can understand it.
Yeah.
If you're investing for a time frame of, let's say, 1 year, 5 years, and 10 years, let's kind of do those three. There are obviously different goals will have different time horizons, but we can make life a little bit simple for people. in my view, and I feel quite strongly about this, if you're investing for a year, let's say you're going to put down a deposit on a house in a year's time, or whatever the deal is. If your goal's a year or less, you should not be doing anything other than trying to earn the maximum amount of interest that you possibly can. In other words, a money market fund, maybe an income unit trust, but you're in the space of money market and income unit trusts, and where you are definitely not is in the space of a global equity unit trust, which invests in shares, or even South African equity, or and I'm kind of cutting out a whole world of unit trusts now, but let's say a balanced unit trust which has got a high exposure to shares. The reality is the stock market is your best way of getting long-term capital growth, but over a year, the chances are that it could go up by a third, or it could be down by a third, and none of us have a cooking clue what it's going to do in the next 12 months. And if you've got a defined goal within a 1 year period, you certainly can't take the chance to allocate money to the markets. Even if, I might say it thousands of times in a year that the stock market is your best engine for growth. It is, but it comes with this thing called volatility, and you just don't want to take your money, park it into a money market account, and then in a year's time, you can't buy the house because your deposit is now not 100,000, it's 77,000.
No, you're spot on. It's probably the most critical decision to make, right? To decide how long are you going to invest for. Because as soon as you can match that to the fund, to the right fund, then at least you can stomach some of these ups and downs and the tops and tails that happen in the stock market.
Okay, so now we've got a money market account, and that's for the very short term. And as you say, with the top and tails of the markets, that's not the ideal place if you've got a 1 year time horizon. On the other end of the spectrum, if you've got a 10-year time horizon, then I feel, again, the very last thing you want to do is put all your money in cash and just earn interest for a decade. That doesn't make sense to me. If you've got that time horizon for that amount of money, let's say it is part of your retirement savings, or it's your child has just been born and you'd like to allocate money for their university in 18 years time, then you can afford to have a very large allocation to shares from a time point of view. And so I think that now we're starting to find a way to filter out shares unit trusts from money markets to equity. The in between is maybe the tricky one. And I don't want to put words in your mouth on this one, Ray, but I feel somewhere around that 5 year period, if you're investing for 4, 5, 6 years, somewhere around there in the middle, then you can start to invest in what they call balanced unit trusts, where you take a portion of money inside a unit trust, and that unit trust owns cash, bonds, property, and shares. And there are a whole range, and the names are quite confusing, but the reality is the longer the time horizon, the bigger the allocation to shares you should have in your balanced unit trust. And if your time horizon is shorter, let's say it's that sort of 4 or 5 years, then perhaps you want something like a cautious or a stable unit trust, which has a lower allocation to shares. And the reason here is we're not anti-shares. I love shares. I think they're the right place to be. We don't like volatility attached to a very short time horizon. When you've got 10 years and the market's going crazy, you're not worrying about it because it goes crazy, and it goes crazy in an upward direction. So you're not too worried about, having to exit the investment on a particular day and it's down 30%. You've got time to make that call on your own. But I do think, the starting point, as you say, is understand the goal for the money, and then the goal dictates the time horizon. And that's your first big filtering mechanism for where do we go and what do we avoid in the unit trust market.
Yeah, and I think you raise a good point there, Warren. It's like the risk is actually on both sides. There's the risk that you have a short time horizon and you choose a very racy or volatile fund, and like you said, then you're forced to withdraw at the wrong time, and potentially at a time when the markets are down because you needed that money in the short term, but you invested in a very volatile fund. Or the risk could be the other way, where you've got a very long term, such as investing for retirement, or your kids' education, and they're only 5, like mine, and then you go put it into a money market fund when you should actually have, like you said, some shares so you can participate in the growth of the market. So you've got to be, that decision is so critical. The time horizon, why you're investing, it is probably the most critical decision, like I said, that is going to help you make that decision. The balance fund that you touched on, like you said, is somewhere in between, and why that fund exists. And I think and the stable funds, which are more cautious, those funds are fantastic funds because they're more diversified. So they're somewhere in between, and they allow a client who's somewhere between that 1 year kind of keeping your money in a cash or warm for something else versus someone saving for retirement. And it's somewhere in between that allows investors to then almost grade themselves up to levels of risk from very little risk or volatility. And I suppose what I mean by risk here is how much is the market going up and how much is the market going down, and will you need that money at that time? So it's from very little risk to the very high risk. And that's what these cautious funds or stable funds and balance funds do for you. They allow you to grade yourself based on that goal that you've set and how long you've got to invest in terms of which fund to then select next.
So now we've got kind of maybe we've gone from 100,000 unit trusts around the world and we're down to, let's say, 20,000, but it's still a heck of a lot of unit trusts.
Mm.
And so now we've got to make the next call, which is, and I think it's a little bit of psychology, because it's not something that it's not like a credit score or a mathematical score. It's something which they've got lots of names for it, but it's your ability to deal with stock market volatility or the movement of investments. Some people will call it your risk tolerance. And unfortunately, that's a psychological thing. And I feel very strongly that it's hardwired into us. It's not something that we can educate ourselves to be more tolerant for risk or less. We're born with it much in the same way as you're born with a fear of heights or whatever it is. Like for me, it's a fear of my wife when she's cross. So all of those are things that are hardwired into us. And so it does help you though a heck of a lot once you understand your time goal for your money, and you've now got a selection of possible unit trusts. To narrow that down further, you look at your tolerance for risk and you match that to the funds. And I think it's probably the one that where we go from being investment as a science to an investment kind of as a judgment or as an art almost, right?
Yeah, absolutely. And I'll give you a great example. When I started in the investments industry, my mom she wanted to back her son, obviously. So she asked me to invest some money for her. And I asked her how long she wanted to invest it for and what the goal was. And she just said, there's no goal. Just give me one that gives me the highest return, and I'll be invested for as long as you say. And I could have said to her, she'll put you into an equity fund or a global equity fund and your money's going to grow. But I would never do that to my mother, because to this day, she phones every year to check how much is in there. And if it's slightly down, she panics. And I think that's what we're talking about when we talk about tolerance is how easy will you sleep at night if the market has gone down by 10%, by 20%? Like, God forbid, it's COVID and it goes down by much more. And my mom is not one of those people. So even though she had the capacity or she had the time and the objective to invest long term, it doesn't automatically mean that you should. It's your tolerance and how much can you tolerate the stock market movements going up and down, and what will that do to you? If you're going to wake up and if you're going to have a heart attack, if your money's gone down by 20%, you probably shouldn't be taking on a global emerging market fund in China, for example, because those things do happen and they will. It's not even a question of will it happen? I mean, if it happens, it's a question of when that it happens, and you don't really. That's what tolerance is all about when you're thinking about what funds to invest in.
Yeah, no, I like to think of that market volatility as a bit like the tide. You don't exactly know when it comes in and when it goes out. You know it's going to come in and go out, and it's going to do it lots and lots of times in your career as an investor. And so then it's about saying, can I stomach those down times and wait them out? I mean, we're not talking about something where you're going to see a permanent loss of capital. Investing in the stock markets, they're by nature, if you're appropriately diversified within the stock markets, your potential for actually losing money over a 5 or 10 year period is very small. But over a 1 or 2 or 3 year period, you could get an almighty ride. And then it's about saying, okay, I know for myself that if I see my statement and I had 100,000 and now it's 70,000, I'm not going to ride it out. I'm not going to be able to sleep. I'm definitely going to just say, cut my losses, move it all to cash. Then what you know is you've got a low tolerance for risk. And it's not a judgment of you as a human being or your qualities or anything. It's just understanding that's who you are. That's how you hardwired. Knowing that up front allows you to narrow down your universe of investments even more. So I would sort of say, even if you've got a 10-year time horizon and you've got the ability to invest in global shares, if you can't sleep at night once you're down kind of 15%, so your 100,000 is now sitting at 80,000, and you need to say, global shares might be the place according to the textbook, but according to my hardwiring as a human being, I need to scale down that allocation to shares. I would dearly hope that, as an investor, that you don't go all the way to cash, because what you've done then is locked in the certainty that you won't beat inflation with your.
Can I just add, if I can just add another thing there on top of that, and why it's important is it actually it helps you stay the course. Because if you get the tolerance wrong, if you get the fund wrong relative to your tolerance, it means that when the markets do something or start, there is high volatility, but you've chosen and you don't have the tolerance for that. You're going to do what most people shouldn't do and disinvest the money. Whereas one of the number one rules of investing is to stay invested for as long as possible. And ideally, if you get that right, then it will allow you to stay the course no matter what happens. And that's why it's so critical to get your tolerance matched to the right type of fund that suits that risk tolerance.
I think it's actually a PowerPoint. We should have said it at the start. Ray, is like your goal here as an investor. Your job is to stay the course for the duration. Actually, it's the thing that most people can't get right, is they can't just stay invested. And if they did that, they would do a far better job than the people that are always trying to kind of buy low, sell high, or choose the very best fund of the last 3 months and hope that that's going to be the next fund that will deliver for the next 3 months. So all of that chopping and changing and trying to be super clever. If you can kind of just narrow your choices down, make an investment selection, and then stay the course, provided nothing's gone wrong with the fund. In other words, the whole management team haven't resigned or something like that. If you can just stick with the fund that you've chosen and it is the right fund for you, you will achieve success in more instances than not. Nothing's guaranteed, but what is certain is chopping and changing does erode and destroy growth, and kind of being consistent and staying invested tends to be very rewarding for investors. So I think you make a brilliant point there. I want to talk about maybe the last sort of filtering criteria before we get to some nuts and bolts. And that will be, the jargon for this is your financial capacity for risk. And essentially, how big is your bank balance? How much capital have you got? Can you afford to invest? If you said, this is my goal, let's say it's a 10-year goal, I've got a high tolerance for risk, but at the same time, you actually don't have, an emergency fund, and you've got a whole lot of personal loans and overdrafts and all that stuff, then the reality is that you actually don't have the financial capacity to take risk. What you should be doing is taking your money and paying down your credit cards and your personal loans and your overdrafts, because there are other things that are more pressing and more important to do with your money than take a 10-year investment where your credit cards are compounding against you at 25% a year. So financial capacity is the other big criteria, and it's, I always think it kind of comes third in the rankings of criteria, because it does help you just make some kind of more rational choices once you've kind of gone past the emotive side of investing.
Yeah, and I suppose that's where great people like you, financial advisors, get involved, right? So trying to help a client to decide, when do you start investing? What should I have done first? Ideally, you should have covered all your bad debt, let's call it, and made sure that you paid off anything that's actually going to charge you a lot of interest. That's a capacity that you want to create the capacity in order for you to invest. You want to make sure that you've got well, I'm not an advisor, so I should be careful here. I can't give advice, but you want to make sure that the kind of things that you have, things like a good debt, before you start going into things like investments. And even then, what do you start with? Like you said, do you have an emergency fund before you start investing into high risk equity funds? So if something does happen in your family, you can sort that out without having to withdraw in case that withdrawal happens when the markets are down. Bad idea. Have you got your kids' education sorted out for the next 12 months? Have you got all these other things sorted? And then at that point, you have your tax-free savings account. And then after that, you then start looking at, what should I be investing in for, and for how long? And then you can start making these decisions. But again, I think you'd be a better judge of that, and you'd probably do a better job of telling people when to do that than I would. I'm just a lowly investment manager.
So I think you're underselling yourself there. Otherwise, we wouldn't have you on the show, Ray. So now, let's say we've got all those criteria narrowed down, and we've decided, we've found a sector of unit trusts that are exactly appropriate for our tolerance, our time horizon, and our capacity. The thing about a sector of unit trusts is it could be 200 or 300 funds in one category or one sector. And that's still too much work to now go and individually kind of, research every single fund and every single fund manager, etc. So we need to find a way to narrow that down a bit further. And I thought we should maybe start with the F word, Ray, the fees around investments. And I mean, for me, again, it's important that the fee is appropriate. I think we're getting to the time where the understanding, like, the lowest fees are not always best, but equally highest fees I always think are problematic.
Yeah, and I think at this point, I suppose you move from, you've done your work, you've decided what your goals, your risk tolerance, your risk capacity, and now it's time for the asset managers to do their work, or at least to show that they do their work. And fees is certainly a very good place to start. It's what's a good fee? I always go with fair. What's a fair fee? What are you paying for, and what are you getting for it? That's a good place for me to start. And I think in our industry, there's different types of fees to look at. There's, like you said, there's always low fees don't necessarily mean a good thing, but there is sometimes a good reason for low fees. If there's no well, there's a difference between active versus passive funds that you need to look at. A passive fund is a fund that is more systematic. There's probably a lot of data and computers behind it, whereas an active fund probably has a team of people behind it and it costs more to manage. So that sometimes fees are justified because there are people around it and it's a bit costlier to manage the fund. So you have to look at those kind of things when determining whether the fee that you're being charged is fair or isn't fair. As I said, something that's a little more systematic, is data driven, created some sort of AI product, or just follows an index. I suppose that's a good easy one. If you're just following the index and you've decided to just follow the Johannesburg Stock Exchange, for example, there's very little human intervention that goes into the accept administration for it. Therefore, a fund like that should probably not cost more than a fund where they're trying to beat the index and they're called an active fund and they've got a team of, say, 10 investment managers trying to do that. And I think that's how people should look at this in terms of what is fair and what isn't fair. What are you being charged and what is it for?
So if we look at that, the way that you would find that information is, I mean, you can search nowadays. I guess the AI engines will help you filter out a lot of the stuff quite quickly. But, if you just Google the company's fact sheets, that you'll find that information disclosed. They're obliged nowadays to be very clear and transparent on their fees, which is great. And one of to me, the one that you really want to look for is the thing called TIC, the total investment charge. What is as much as possible all the fees that I'm paying for my unit trust? If we look at, let's say, a global or a local just stock market fund where it's an active manager, do you think there's a range, Ray, where you would say, okay, over this level, I think it's a bit rich, or do you want me to take a dip?
No, well, look, are we talking actively managed or passively managed?
Yes. Yeah. So,
Okay.
so someone who's trying to beat the index, whether it's a local stock market or a global market index.
Yeah, so I think if you're just trying to beat the index, or if you are just trying to track the index and that's all you're doing, I personally do not believe a fee over 0.5, 0.6% is fair for me in terms of the investment management fee. If I look at then, obviously when you say total investment charge, you then have to consider things like administration and all the other things that are included in the fee. And then if you are looking at a actively managed fund, anything above 1.5% for me sounds exorbitant. I don't think anything. I struggle to see why someone would charge anything more than that from an actively managed fund. That's my personal view, but you're the financial advisor. Like I said, you've probably seen a few of these, and you can tell what people have done. But again, it's quite a hard thing to measure against, right? It's to assess, because without seeing what it is that the individuals or the investment manager is actually doing in the fund, you'll get some people who charge a performance-based fee, and they'll say that because they outperformed, they've told you upfront that this is what they do. That if they outperform by a certain index by a certain amount, they will take a proportion of that fee as their own, and they'll participate in that upside. And if they do, sometimes those fees do get a bit higher. And I suppose there's big debate around that, and you would have seen quite a bit of that, and it's part of your narrative when you talk to your clients.
Yeah, I think it's one of those things where the just understand as investors looking at fund managers generally very sharp people. They're very bright and some of them are even eloquent. And so they've always got a very good argument for why they would charge their fees. And if we go back to performance fees, for example, you talk to a hedge fund manager and they'll give you fantastic reasons why they're going to charge you 2% as a annual management fee and 20% as a performance fee of any growth that you are lucky enough to get. And so for me, I would be saying to people, just be very careful. Like when you get a flat fee of 2% a year and a performance fee of 20% a year, look at the cars that the hedge fund guys are driving and look at the sponsors, like the sponsorships that they're doing and the things they're giving away and the like. And you can see where your fees are going, and it's probably not to your growth. And so I would be very skeptical of that. But I like your view, and I appreciate you putting yourself out there. I think 1.5% for an active fund, on an all-in basis is a fair fee. it's also one of those things which people might be surprised to hear me say, that fees can be too low. And certainly it's a drum that I've beaten for a long time, that fees must come down. But I do feel that fees have come down to the point where, in a lot of instances, where they are now fair and correct. What you don't want is, you don't want to be an investor where you've put money into a fund, you think you've got the right fund, there's a good team managing that money, and their fees are simply so low that they don't have a sustainable business. And what happens is, 3 or 4 years in, the business closes and your money gets paid back to you, because there's no one to manage the money anymore. So I think that, over time we've seen that, where some very good teams have just been too aggressive on very low fees, and they get to the point where their businesses get gobbled up by other businesses, or they just don't get to sustainability in terms of size of assets. So I think it's just understanding why I don't think zero is an appropriate fee. Equally, why I think 2 and 20 is a terrible fee.
Even for the hedge funds.
Well, for any investment, I just don't. I'm not a fan of 2 and 20. I think paying away. I don't mind if they say, we'll take a percentage of the performance, but in bad times we'll not draw a fee. When we're losing your money, we'll take the pain with you. But if they're going to charge you 2% a year and give you 20% of the outperformance, for me it's tough. Like, I can't justify to myself that I do that. So I think for a lot of people love hedge funds, and they find very good growth, and maybe they're happy to pay it. There's certainly some very wealthy hedge fund managers in the world that will claim that they've done very good work for their clients. So maybe there is a case. For me, no, and this is an honest money show. We've got to be honest here.
Yeah. And I suppose fees are just one thing, right? The other thing to look at is exactly what are they charging it for? So are they doing what they said they were going to do? So choosing the right fund, but as we said earlier, is you want to make sure that investment manager you can trust that you've selected the fund. You selected a fund that will do exactly what it said it's going to do on the tin. So if you said you wanted a low volatility, low equity fund, you want to look at this track record. You want to look at the fund's track record to see, has it done that consistently throughout time? And what I mean by that is, obviously, the stock markets go up and the stock markets go down. The track record is not any indication of what's going to happen in future. It at least gives you a good idea of how that manager or investment or the fund has performed during different market cycles. That's what I mean when I say markets going up and going down, because you've paid for that. And you've done your job to ensure that you've selected the right fund based on your goals and your time horizon. You want to make sure that they're doing their job and doing what you expect them to do, because that's what you're paying for.
And I think it's a very good point there that, for example, we've seen on the South African market where, money market unit trust, that's in theory is very low risk, consistently doing 2 or 3% a year better than its peers, where they might only be getting 6 or 7% a year. It's very difficult to understand how a money market fund can do 50% more. In other words, it can go to 9%. And then, surprise, surprise, what happens is that money market fund blows up because they were taking too much risk. So even in something which is in theory a conservative, very low risk investment, if it's just doing way better than its competitors, that's a red flag. You need to understand exactly what it's doing. And if you can't understand why that fund is delivering such a good return relative to its peers, exercise caution. I think in the stock market side, it's easier to understand. You might find that an active manager takes a particular view. If we go back 2 or 3 years, you might find that a South African manager looked at the world stock markets and said, I'm going to take a big position in resources. I think gold is going to be the next big thing. And 2 or 3 years later, the performance would have been fantastic. And it's way better, for example, than someone who's put a whole lot of money in South African retail shares. The retail shares might have given you 12% over a year, and the resources might have given you 150%. And then you go, I can understand. It makes sense to me. Whether you want a manager that's going to take such big positions, it's great when they work out. But remember, there is the other side of performance. It can be that those positions don't work out, and then you're in the loss. So that consistency that you mentioned, Ray, I think is very important.
And it's also, if I can just add to that, Warren, so it's also important that you also measure it relative to the time horizon of the fund itself. We mentioned your own time horizon. And remember, these funds have selected time horizons. So when you're looking at its track record, don't just look at its track record over, if it's an equity fund, don't look at its track record over 1 year. An equity fund, you're likely to be invested for 7 years or more. So look at how well it's done for the period that you're meant to be invested in. If you look at it over 1 year and it's a bad year or the markets have gone down, it clearly won't be showing anything great. But if you look at it over the long run, you want to see that consistency over the time period that you're supposed to be investing in the fund that you've chosen for your goals.
Ray, we're burning through our time here, so I want to give you a chance if you think there are any other kind of criteria that we should be looking at before we wrap this one up.
I suppose I think you've touched on most things. There's lots. There's so much, Warren. There's quite a lot that you could, if you really want to dig into this, there's a lot that you can go into when you're trying to select a unit trust fund. And I suppose that's what makes it quite difficult. But I think so far we've touched on the critical points that one would need to look at when assessing which funds to invest in.
And so I think, maybe just to emphasize what Ray said, in the show, your job as an investor is to stick with the plan, stick with the goal. Once you've set the goal, once you've narrowed that selection down and you've picked the fund, then stay in. The reason that you sell out of a fund is not because it goes down for a year. It's, if you're investing in a global equity fund where you've got a manager that's trying to do better than the market, it's extremely likely that manager is going to have 2 or 3 periods of time over a 10-year track record where they underperform. And that's actually the job. They are trying to not be the market. And that means that, over a decade, they would hope that they're better than the market, but there will be times when they might have a position and go and start that position a bit early or whatever the deal is. Investing is not an exact science. So your job is stay invested. And the reason that you sell out of a fund is because they raise their fees or the whole asset management company, that team walks out the door, or there is some very big structural change in the reason why you chose that particular fund by that particular asset manager. That's a great reason to exit and move on. But it's not a great reason to sell out if, as I say, 1 year period, things aren't going perfectly. And equally, you can't look at performance rankings and say, well, the fund I'm in today, it's number 12 out of 12 in the category, and I only want to be number 1, because whatever was number 1 this year, there's very good chance it's not going to be number 1 next year. So rankings and the like for me are not that important until you start getting to 7, 10, 12-year periods. Then the funds that have done well over those kinds of timeframes, the likelihood is that's the cream that's risen to the top. But you look at those very good funds that have got a fantastic track record over a decade, and you measure them over a 1-year period, very often they might be at the bottom of their respective categories over a year. They might be near the bottom. That's life. Like that's the job they're doing, and that's the job they get paid to do. Good performance happens over time. Luck happens over the short term is probably the best way I can summarize this.
It's a great summary. Great summary one. And I think just from an investor's perspective, if you get all of this right, it's not a big if. It's actually, if you do all of these things, then you will stay invested for the long term, and then you will achieve your goals. I think a lot of people are scared of investing because they're worried about, are they going to invest in the right fund? If you take all of these little nuggets that you've shared today and that we've discussed now, it allows you then to invest for certain goals and be invested in certain funds for the periods that you're supposed to be in. An ex-colleague of mine used to compare investing to having cattle. And he used to say, you'll never ask your father how long he's going to have cattle for, because you'd have cattle for life. And ideally, we should all be investing for life. You should invest for your kids. You should invest for retirement. You should always be invested. And if you do it the right way, you'll be fine.
I can't add anything to that. Ray Mhere, CEO of Curate Investments, thanks so much for joining us. It was a pleasure to have you on the show again, and we certainly will invite you back.
Cheers, Warren. Good to see you again.
This podcast is brought to you by Curate Investments. Each of our funds is managed by different teams of highly skilled people we have handpicked to look after your money. That is the art of investing. For more information, visit us at curateinvestments.co.za. Curate Investments is an authorized FSP.